If you're joining a bank's markets division for the first time, or trying to understand what it actually does from the outside, you're in exactly the right place. Over the next 10 minutes, I'm going to give you a clear picture of what a bank's markets business is, how it fits inside a universal bank, and how it makes money. No jargon, no assumed knowledge, just the real picture that most training programs skip entirely. Let's start with where markets fits inside a bank. A universal bank, the kind you see in London, New York, Frankfurt, or Hong Kong, typically runs several distinct businesses under one roof. There's the retail bank, current accounts, mortgages, personal loans. There's the corporate bank, business lending, trade finance, cash management. And then there's the investment bank, which itself has two main parts. The first is advisory and capital raising, helping companies merge, acquire, float on a stock exchange, or issue bonds. That's what most people picture when they hear the words investment banking. The second part, and this is what this course is about, is the markets division, also called the trading division, or simply markets. The markets division is where the bank facilitates trading, not trading for its own account the way a hedge fund does, but acting as an intermediary between clients who want to buy and sell financial products. So, what does facilitating trading mean in practice? Think of the markets division as a very sophisticated financial intermediary. Clients come to the bank with a need. They want to buy exposure to an asset, hedge a risk, or exchange one currency for another. The bank prices that transaction, takes the other side of the trade, and manages the resulting risk on its own book. Here's a concrete example. A UK company is about to receive $100 million from a sale in America. They're worried the dollar might fall before they convert those funds into sterling. So they call their bank's FX desk and ask for a forward contract, an agreement to exchange those dollars for pounds at a fixed rate in 3 months' time. The bank's sales team takes the call, agrees the rate with the trader, and the deal is done. The corporate treasurer has locked in their exchange rate and removed their currency risk. The bank now holds the opposite position, and the trader's job is to manage that risk. That is markets in one sentence. The bank takes on risk from clients who don't want it, and manages that risk for a fee. Now, how does the bank actually make money from this? The primary mechanism is the bid-offer spread. When a trader quotes a price to a client, they quote two numbers. The bid, the price they'll buy at, and the offer, the price they'll sell at. The difference between those two numbers is the spread. That spread is the bank's gross profit on the trade, before costs and hedging. On a heavily traded instrument like Spot FX, that spread might be tiny, fractions of a basis point. But the bank is processing thousands of those trades every day, so volume makes up for the thin margin. On a complex structured product, a bespoke interest rate swap designed for a corporate client, the spread is much wider, because the bank is taking on complexity and illiquidity in exchange for a larger fee. The second revenue stream is structuring fees. When the bank designs a bespoke product for a client, it earns an upfront fee on top of the spread. And the third is financing. The bank lends money to hedge funds and asset managers to fund their trading positions, and that generates interest income. 3 revenue streams: spread, structuring fees, and financing. Everything the markets division does maps back to one of those 3. Let's talk about who actually uses the markets division. The client base falls into 3 broad categories. First, institutional investors, pension funds, asset managers, insurance companies, sovereign wealth funds. These are large pools of capital that need to buy and sell financial instruments constantly to manage their portfolios and liabilities. Second, hedge funds. More active traders, often using leverage, often running complex strategies across multiple asset classes simultaneously. They're high-volume clients and demanding counterparties, and the bank's markets division competes hard for their flow. Third, corporates. Companies that need to manage real-world financial risks, the multinational hedging currency exposure on overseas revenues, the airline hedging jet fuel costs with oil derivatives, The property developer fixing their borrowing rate with an interest rate swap. These clients don't want financial complexity. They want a solution to a specific business problem. Understanding who the client is and what they're trying to achieve is the starting point for everything that follows in this course. If you want to go beyond this course and into the full detail, everything we cover across these 26 episodes, and considerably more, is set out in the book this course is based on. Market Mechanics: How a Bank's Markets Business Really Works. It covers the complete structure of a trading floor, how every major product class is priced and risk managed, what each front office role actually does on a real trading day, and how careers in markets are built and measured. It's published internationally and available on Amazon worldwide. Search for Market Mechanics or visit markaxis-advisory.com. In the next episode, we go inside the markets division itself, meeting sales, trading, structuring, and research, and seeing what each team actually does. I'll see you there.